What if I told you that making fewer trades could make you more money? It's true, and I'll explain more, but there are 10 harsh trading facts that can give you a huge advantage in trading that no one talks about. That's going to change today. I've worked with hundreds of investors to help them become consistently profitable and get results like these, and understanding these facts had a big part to do with their success. I'll share a surprising fact later on that will completely change how you view risk in trading, so stay tuned. The first fact is that 90% of traders lose money. Yeah. Love it or hate it, it's true. And let me tell you about John, one of my students. He was a new trader who thought he could make fast money by following what everyone was talking about online. He kept seeing people on Reddit and Twitter hyping up stocks. Oh yeah, Twitter's X now, so X, right? Like GameStop and AMC, the buzz was all over the place and John didn't want to miss out. So he jumped in, thinking he could ride the wave and get rich quickly. At first, it seemed like a good idea because the stocks were shooting up. But then just as fast as they went up, the stocks crashed. John had put a big chunk of his money into AMC and he lost a lot when the price dropped suddenly. That loss made John stop and think. He realized that he had been chasing hype without really knowing what he was doing. He wasn't making smart trades, he was just afraid of missing out on the next big thing. Deep down, he knew this wasn't the right way to trade. As he kept losing money, his confidence took a hit. He started to worry that if he didn't change his approach, he might lose everything he had worked on so hard to save. On top of that, his portfolio was shrinking fast. He knew if he kept going this way, he could wipe out all of his savings. It wasn't just about the money anymore, it was about his future as a trader. He had to make a change or give up. The hardest part of John was learning to be patient. He had to stop chasing every hot stock he saw online. Instead of jumping into trades like GameStop, just because everyone else was talking about it, he took a step back. He started studying how to find good stocks and waited for the right setups. It wasn't easy. His friends were still trading stocks like Tesla and bragging about their big gains and quick gains, but John stayed disciplined. Instead of making trades every day, John learned to wait for the right opportunity. He studied companies like Apple and Microsoft, learning how to make smart, informed trades. He built a plan and stuck to it. Over time, his account started to grow again. It wasn't fast or exciting like those meme stocks, but it was steady and consistent. The biggest lesson John learned: you don't need to chase every stock to succeed. By being patient and disciplined, John finally saw real lasting results, and so can you. That leads us to the second fact. You don't need a high win rate to be profitable. Winning 40% of your trades is enough to make money. Think about trading like fishing. You don't need to catch every fish, just the right ones. Success doesn't come from catching everything you see, but from being patient and waiting for the right opportunities. Just like a fisherman doesn't try to catch every fish in the ocean, but waits for the ones that are worth it. A trader doesn't need to win every single trade. Instead, they focus on finding the right setups where the reward outweighs the risk, leading to more consistent profits in the long run. It's all about quality, not quantity. And think about it like this. If you lose 50 cents on a trade and you make $1 on a trade, you can afford to lose 3 trades, so you lost $1.50. But if you win 2 trades, you won $2. You're still profitable with $2 minus the $1.50, right? So you don't need a huge win rate for that. So yeah, I think that should make sense. Next is a hard fact for most traders to swallow, and it's one that I really have to drill down for my students. Psychology is more important than strategy. Your mind is your biggest asset, or your worst enemy. Let's take the example of Apple in March of 2020. At the beginning of the pandemic, many traders were fearful as the stock market dropped rapidly. Apple's stock price fell from around $320 to $224 in just a few weeks. Out of fear that it would drop further, many traders sold their shares at the bottom, worried that they would lose even more money. However, those who panicked and sold missed out on the massive rebound that followed. By the end of 2020, Apple stock had soared to over $130 per share post-split, meaning they could have made a significant profit if they had just stayed patient and not let fear dictate their decision. On the other hand, let's look at Zoom, okay? Zoom video communications, right? During the pandemic in 2020, Zoom stock surged as the demand for video conferencing skyrocketed. The stock went from around $70 in January of 2020 to a high of over $550 by October of 2020. Many traders, driven by greed, believed the stock would keep rising indefinitely due to the massive shift in remote work. However, as the pandemic began to ease and competition increased, Zoom stock started to decline. By mid-2021, the stock had dropped below $300, and by 2022, it fell even further to around $100. Right now, at the time of this recording, it's trading at around $66. Traders traders who held on to Zoom hoping for continued growth lost a significant portion of their gains by not taking profits at the peak, right? That brings us to trading fact number 4. The market doesn't care about you. The market moves regardless of your trades. Let me tell you about Tammy, a trader who thought she could predict the stock market, right? She's like, yeah. Tammy was really confident and believed that by following the news, she could always know which stocks would go up. In 2022, she was sure that Tesla was going to keep rising because it had been performing so well in the past. Tammy put a lot of her savings into Tesla, thinking the stock would keep climbing. But then the market started to change. Tesla stock dropped from over $400 to around $100 over the next several months. Tammy lost a big part of her money and realized the hard truth. No matter how much you think you know, the stock market is unpredictable. After that, Tammy changed her strategy. Instead of trying to predict the future, she started focusing on protecting her money by using stop losses and investing in multiple stocks. The most important lesson Tammy learned, you can't control the market, but you can control how much risk you take by being prepared for anything. That's why a bunch of trades that I make, that I share in my Patreon, are based on collecting premium on option trades. So the stock could go up, down, sideways, and we still make money, right? If you want to check it out, I've got a link to it in the description below. The 5th fact is another one of those that takes people time to understand. Trading less could actually earn you more. Smart trading is fewer and simple trades. Don't be an action junkie, okay? Those traders lose a lot of money. That's like being in a casino. Don't be an action junkie, please. So now, let's talk about Mark. He's a trader who thought more trades meant more money. Mark was like a kid at an all-you-can-eat buffet, grabbing everything that he could as fast as possible. He made over 20 trades in 1 week, jumping in and out of stocks like Apple and Tesla, thinking he'd be swimming in profits by Friday. But instead of raking in the dough, Mark was paying more in trading fees than he was making in returns. It was like he was ordering the fanciest meal at a restaurant and tipping the waiter 100%. He was losing money faster than he could make it. Meanwhile, Sarah was just sitting back, sipping her coffee, and holding on to a few solid stocks like Microsoft and Amazon. She wasn't in a rush. She let her investments do the heavy lifting while Mark was sweating every single price movement. By the time Mark realized that he was just spinning his wheels, Sarah's portfolio was growing steadily like a well-watered plant. The lesson? Overtrading is like trying to win a marathon by sprinting every 10 feet. You will just wear yourself out. Sometimes sitting back and being patient is the smartest move you can make. Now for fact number 6. High volatility doesn't always mean high profitability. More volatility means more risk, not more reward. Okay, so how do I explain this? Imagine a trader stepping onto a basketball court during the NBA Finals thinking they've got what it takes to go head-to-head with LeBron James. The game starts, and at first, they're dribbling around, feeling pretty good. But suddenly, the pace picks up, players are zooming past, and LeBron is dunking left and right. The court turns into a complete chaos, just like the volatile market. Instead of calling a timeout to regroup, using risk management, right? The trader decides to charge full speed ahead, thinking they'll somehow outplay the pros. Spoiler alert, they get flattened like a pancake in the paint. In trading, when the market bounces up and down like a high-stakes basketball game, not managing your risk is like trying to take on the MVP without a game plan. You'll end up on the sidelines wondering how you got dunked on so hard. Ready for the next fact? Even hedge funds don't beat the market every year. Yeah, even the pros don't always beat the market. Think of hedge funds like those superstar sports teams, loaded with talent, big budgets, and all the fancy equipment. They've got the star players, the analysts, the best coaches, the fund managers, and all the playbooks you could dream of, the financial strategies. But even with all that, sometimes they still lose a game. It's like watching the New York Yankees get crushed by a team no one's heard of. It happens. And it's a reminder that even the best can have an off day. In the world of trading, just like in sports, no matter how much experience or skill you have, you can't win every time. Hedge funds may be like the all-star teams, but even they take a hit now and then. The lesson? Everyone gets a bad game. It's how you bounce back that counts. Fact number 8 is for all of you that put so much emphasis on the news. News isn't as important as you think. By the time you hear the news, it's too late. Let's take Amazon in July 2021 as an example. Before the company's earnings report was officially released, and there were rumors and predictions that Amazon's sales might not meet expectations. Professional traders and big institutions were already positioning themselves based on this inside knowledge and market predictions. When Amazon's earnings reports actually came out and showed slower than expected sales, the stock immediately dropped around 7%. By the time most retail traders saw the news and thought about selling selling their shares, the stock had already taken a dive. This shows how big players often react before news is public. And by the time everyday traders try to act, the market has already priced in the information. It's like arriving late to a sale. By the time you get there, all the good stuff is already gone. Next one may hurt your feelings, all right? Your broker is profiting whether you win or lose. Remember Mark from the other example, right? The guy who was overtrading, trying to catch every little market movement? Well, while he was busy making dozens of trades every day, jumping in and out of stocks like Tesla and Apple, his broker was having a field day. Remember? The waiter who got 100% tip, that's the broker. You see, every time Mark made a trade, his broker collected a fee. Even though some of Mark's trades made small profits, those gains were quickly wiped out by all the fees he was paying. At the end of the month, Mark checked his account and realized that despite all of his hard work and constant trading, he hadn't really made much money at all. In fact, his broker was the one getting richer off of all of those fees while Mark's account stayed flat. It was like Mark was running around in circles trying to win a race, but his broker was just on the sidelines raking in the cash without breaking a sweat. If you take anything from this video, please let it be this next trading fact that no one else is telling you, okay? Trading success is boring. Yes, please let that sink in. Successful trading is not exciting. It's repetitive and disciplined. Let me tell you a short story about myself, AK, all right? And how I learned that trading doesn't need to be exciting to be profitable. I used to chase the thrill, jumping into fast-moving stocks and trying to hit more home runs every time, right? It felt like I was always in the middle of a high-stakes game. Heart racing, adrenaline pumping, but after a few too many losses and late nights thinking, hey, what was I thinking? Like, what was I thinking? Those kind of moments, I realized something. Excitement was costing me more than it was making me. So I switched things up. I created a routine, a boring routine, and I focused on making smart quality trades, managing my risk, and sticking to my plan. No more chasing the latest hot stock or trying to time the market perfectly. And guess what? It worked. My portfolio started growing steadily. It wasn't the fireworks show that I was used to, but the results were there. It was like trading went from being a wild roller coaster to a steady walk in the park. Boring? Absolutely. But profitable? You bet. The lesson? Sometimes the best way to win is to play it safe and keep it simple. Boring is the new exciting, my friends. And there's still a major problem most traders face. Even with this knowledge, many traders struggle with discipline and emotions. Check out my next video on how you can fix that problem.